Greetings. Hey, thanks for being here on the Business of Agriculture podcast. It's me, Damian Mason. Got a great show for you today because I've got a great guest. I always get great guests, right? This is Chris Barron. He's with AgView Solutions. Before AgView Solutions and Chris Barron get to talk, I want to remind you that this podcast is sponsored by Harvest Profit Ag. Harvest Profit is a software solution company that helps your operation become more profitable. You know, the inputs and the outlays and all the stuff that makes your farming and ag enterprise a business, you need the right software. So look at harvestprofit.com, and my man Nick Horrible sets you up. You can even get a 14-day free trial. This episode of the Business of Agriculture is a video as well as an audio. So wherever you get your podcast, you can also go on YouTube. It's the Damian Mason channel, and you can watch me and Chris Barron talk. He's got a good backdrop. He's a sharp dresser. You want to see this rather than just listen to it. Chris Barron, welcome to the show, man.
Hey, it's great to be here, Damian.
All right, so we're going to talk about the farm economy. That's the thing I probably should have said up front. We're going to talk about the realities of the farm economy. So we've got a bunch of money being thrown at the farm economy from the federal government, which of course happens a lot. You know, there was always some level of crop insurance subsidization. We've got some farm payments. You know, they go to the FSA office more this year than years past. About $37 billion is what I'm hearing and reading is going to be thrown at the farm economy from the federal government. But also, you're going to give me some reality and some numbers and how things look. So 2020 moving forward, let's talk about the farm economy.
Well, appreciate that. I guess the farm economy, I'm going to relate it to 2019's weather. 2019, we had just all kinds of issues thrown at us, tons and tons of problems with planting, tons and tons of issues just during the growing season, and people couldn't wait for 2019 to be over. Then we get into this economic fun of the commodity prices really being under pressure this entire year. COVID hits, it affects ethanol, it affects all kinds of things that have a direct impact, whether it's on the livestock side of things or on the crop side of things or on the specialty crop side of things. It's kind of nailed all of us in agriculture. And so it's been a really trying year, and I think people can't wait for 2020 to be over. And so having said that, to bring up what you started to talk about, I think it's real important to understand that, when listeners that you have on this podcast that are not ag oriented understand that part of the government money or their tax dollars that come to us as producers is not something that's additionally profitable. It's not extra profit dollars and cents. And I'm not saying anything to anybody that's in ag that doesn't already understand that. But I think it's real important, first of all, for me to make that comment, just because we work with producers with AgView Solutions. We work with producers across the entire United States and in Canada, and we work with business decision making. We work on cost production. We work on transition planning, work on collaboration, succession planning, all of those kinds of things. And we get to see all of these farmers' numbers. We get to see their cash flow. We get to see what they're really dealing with. And when we look at the government payments that came in, and let's go back to 2017, 2018, and 2019, we started to get what was called an MFP payment, a market facilitation payment, which went primarily to row crop operations. And I'll use that as a specific example to start with. That money, or those dollars that came in, were to kind of offset a trade problem that we had, obviously, with China when we got into a sort of a trade war. Well, those dollars and cents basically kept most of the producers whole. And by most, I mean most. There's a few producers that still came up short because the commodity prices were so affected to buy that. And so I guess what I would point out is we're seeing dollars and cents dumped into the equation again this year. I think it's going to keep farmers whole. But I think, as we move forward, I'm not sure as a farmer that I want to continue to live off of government payments. As producers, we really want the free market to operate correctly so that we can make a living off of what we produce and what we market rather than having the government subsidize us.
You know, I've been hearing this for a few years, but the truth is I've been hearing it for almost my whole life, because the reality is, and it's not because we're being mean, it's just, and I'm not judging. It's just, it's been going on. You know, I'm 51 years old. I think you're a touch younger than me, if I'm not mistaken, but you,
I'm actually older than you.
oh, well, you see, you just,
I'm 54, so I've got to beat.
I thought you were like 1 or 2 years younger than me. Okay, so you're 51. So we're old enough to know, okay, I remember government cheese. I remember the payment in kind program. And I know that if you listen to this podcast, you've heard me talk about it. In other words, I've seen federal monies being thrown at agriculture since the first time I picked up the latest edition of the Indiana Prairie Farmer magazine, or whatever ag publication I saw when I was a little kid. It's been going on for a long time. The issue, though, that you're talking about, and by the way, I should say that Chris Barron has a company called AgView Solutions, and he has peer groups with producers. And information sharing, if you will, and helps their business. And also, he's a farmer himself, so you get all this. All right, so we've been throwing money at it, and I know that when the first MFP installment came out, then I saw the farmers took to Twitter and said, I'd rather be able to sell my soybeans than have to go and get this MFP payment. If we didn't have this trade war with China, they'd be buying all of our soybeans. We wouldn't have. I said, well, that's not really why soybean prices got low, because they were still buying soybeans from somewhere on a global marketplace. And we are, after all, in a global marketplace. We just have a glut of soybeans, but a lot of people don't understand that because they struggle with economics. But when you talk about these tranches of money, MFP, then your normal payments, and then also the PPP, which is the Paycheck Protection Program. Some of these farming operations got that. What's 2021 look like? We're going to have less federal monies being thrown at the farm economy?
That's a good question. I think it's going to have somewhat to do, I think, with the administration that is in there at the time. I think it has a lot to do with what we see with commodity prices and what we see with inflation. There's a couple of key things there. And then I also think it has a little bit to do with how much money can the government afford to spend. We continue to spend trillions and trillions of dollars, and we're also a taxpayer. You know, so I really, as a taxpayer, I really don't want to be spending money that if we don't have to spend it, or if we can spend it more intelligently, I'd rather spend it more intelligently through some sort of a risk management protection or some sort of avenue that way, as opposed to, you know, just throwing the money out there. But having said that, I will tell you that as we look at 2021, and we do that with our producers, we look at cost production, we roll where they're at with their current crop 2020, we look at 2021, it looks a little bleak right now. However, you know, as we speak here today, we've seen a pretty decent strength in the marketplace. Commodities have strengthened. I think more so on the food side of things. I think the funds are starting to look at the opportunity for possibly inflation, and the food side of things, I think there's just some dollars starting to flow into that. If that occurs and dollars flow into that commodity sector, I think there would be a lot less need for any kind of government assistance. We have already in place a PLC program and an ARC program, a price loss coverage, and the ARC County that some people have. And I think that in and of itself may be enough.
Chris, you're doing that thing where you're pretending that everybody that listens and watches this podcast know what a PLC and an ARC is. Why don't we go ahead and just, because I have friends and followers that are listening to this so they understand the business of agriculture. And it is, after all, the Business of Agriculture podcast, which is brought to you, by the way, by Harvest Profit. Again, if you have an agricultural enterprise and you need a software solution that will help you manage your inputs, your outputs, the fields you farm, the entire operation, you need a software solution that helps you become more profitable, more streamlined. Go to harvestprofit.com and try it out for 14 days for free. Okay, let's start at the beginning. All right, we said we're going to talk about the farm economy. And unfortunately, for as long as I've been around, the U.S. Department of Agriculture has been an integral part of what the farm economy looks like, because, as I point out in my book, Food Fear, which is all about the business of food and agriculture. The United States Department of Agriculture, founded in the 1860s, Abraham Lincoln called it the People's Program. And what did that mean? It meant it was all about feeding the people. The United States Department of Agriculture has a policy. They want cheap and abundant food because a cheap, abundant food supply means that the American people are well fed. God knows they're well fed. Go to Walmart in Huntington, Indiana. We're replacing those electric scooters with full-blown SUVs. Trust me, they're fed. But here's the thing. We do that because also a well-fed populace is a strong populace and also a generally non-rioting populace. So that's not been exactly true the last couple of months. U.S. Department of Agriculture has been throwing money at agriculture for a long time. And they do want to make sure that the economy is, if it's not good, that it's at least propped up. I don't see it ever changing. But you tell me about these programs that you said would be enough, meaning we're extra heavy on programs this year, but you're saying these other programs that are put in for about 5 years now?
Yeah, I would imagine that we're going to see some changes going into next year too. Again, I think it has a lot to do with the administration that's there and what the House and Senate looks like.
So tell real quickly for these listeners, what are those two programs? You call them the PLC and the ARC. I know what they are, but my listeners don't.
Well, the price loss coverage is to essentially maintain a certain profitable level or a certain price level. And the ARC is based on the ARC, or ARC as it's called, is to keep your price level and your yield level. It's kind of like try to think how I want to explain this. It's sort of like a revenue protection. It's kind of like an insurance coverage level to give you sort of a floor in the market so that you know that you'll stay above that floor. That's kind of a general way to describe it. And to say that that's sufficient is to say that, you know, if we see commodity prices back to where you can, you know, back to levels that maybe we saw in, say, 2008 to 2011, basically, you know, kind of normal levels. We've been subpar since 2013, specifically in the commodity markets, significantly lower than we typically would be. And so that's what's really been difficult. I mean, we sit here when we work with clients and we look at the working capital that a lot of our producers have. Most of our operations that we work with, which are high level producers, have been burning through working capital. They've been burning through their cash because they're not maintaining a profitable level. They're just kind of holding things together from one year to the next. And so
One of the things that people tune in to the Business of Agriculture podcast for is they like the fact that I don't just sit here and nod my head and agree with everything my guests say, especially if they say something that I disagree with. And my friend Chris Barron right here with AgView Solutions just said something that I hear a lot of people in agriculture say. He's letting his farmer show through when he says, if we got commodity prices back to normal like they were between 2008 and 2011, I would say that no. Those were abnormal years. Ag super cycles, where there's a bunch of money getting made in commodity production, is the abnormal year. It is the absolute fluke. It is is not the norm. What we have right now is oversupply, and that's what's normal. Because for about the last 100 years, we've really been managing for oversupply. That's what the USDA wants. They'd rather have 3 billion bushels, 300 million bushels of soybeans left over than to have 300 shortfall. So we've managed for abundance. And what that really means then is, and we've been doing it for as long as I've been paying attention, we've been doing it. And every time I talk to my farm friends, I say, well, if we get back to normal, I said, well, wait a minute. I said, this is normal. The payment in kind program in the 1980s paid farmers with corn to not plant corn. The idea was we would double burn through the corn. We'd get it not planted and also be paying with it. Another program, the one that you're before, the PLC and the ARC, was what they called the LDS, right? LDP.
Loan deficiency payment.
They called it a loan deficiency payment. Now, here's the thing. They called it a loan, but for my little business, when I go and get a loan, I have to pay it back. If you got the loan deficiency payment from the United States Department of Agriculture, you didn't have to pay it back. It was really a price floor. It said, we're going to pay you so much for production. And the truth is, price floors don't work in a true economic sense. However, they keep farming operations producing. And if you feel that that is what the role is to have a bunch of food supply, that's the reason we do it. So
and to tack on to you and agree with your criticism or your critique, I would say that you could take it even a step further. It's back to keeping food prices low. So, if we really wanted to, and I'll speak as a taxpayer now for a minute, if we just didn't even step into that realm, or very limited stepped into that realm with government payments, I think that would be a very interesting direction to go, because you would allow then the free market to determine, and it wouldn't necessarily be a situation where every farmer would maybe survive, or the majority of the farmers would survive a difficult economic challenge, to the point where, the low cost producer, the producer that's the most efficient, those best producers then survive, then obviously we would see high quality productivity come out of those who survive, and we don't just sit there and prop up the bottom third, which, and that's speaking as a taxpayer. So I can talk, I would talk out of both sides of my mouth there too, and say, there is a whole other side of that, because I think land, you look at land values as an example. We look at where cash rents are at. Cash rents are significantly higher than they should be. And part of the reason they're higher than they should be is a portion of that government payment ends up in the landowner's pocket, and it goes right through the farm, right to the land. And so it's artificially holding some of these positions up. But from an economic standpoint, there are a lot of farmers that would be in trouble that have a decent equity position right now, that if those dollars weren't flowing through their equity position would drop dramatically too. And so sometimes I wonder if there's not only, annual economic support, but there's an industry support there, that a portion of that goes to the land. And I'm not sure that's right or wrong. I just, as an observation.
It's good for somebody like me that owns real estate out here in the hinterlands.
Right.
But you could make the argument that, and again, I'm as pro ag as anybody, and so if people want to send me hate mail, they can. I'm just talking frankly. Here's the reality: if I owned 6 dry cleaners, people are not going out and dressing up. Hell, they're not even going to work. They're just sitting at working at home in their pajamas. All of a sudden, I don't have any revenue. There is no program that is going to guarantee me revenue. Now, we did the PPP, but that was a different deal, and it's something that's never usually done. So agriculture has a unique thing in that every year you can about figure that there's going to be a guaranteed amount of revenue through the United States Department of Agriculture. Chris, some people that listen to this are not as good with the economics or agricultural economics. You used a term that I want to make sure you clarify. You said some of these farming operations are burning through working capital, because we're talking about the economy. Right now, they're not in a real flush situation in terms of even specialty crops. The COVID made it so that the salad bars aren't open. So if you're growing tomatoes or lettuce or carrots, you're selling less of them right now. It's a true story. Vegetable consumption has gone down because most people eat their vegetables, if they do, out at a restaurant. So it's not just corn and soybeans. We're talking about everything. And then you said some of these farming operations, their asset position is okay because they own land and
equity position,
grain bins and whatever. And you said they're burning through their working capital. Tell our listeners what that means.
So what we've seen as a trend that's been occurring since about 2014 is where we started to see the trend, where producers' cost of production went up when the commodity prices went up during the time frame of about 2011, 2012. We got commodity prices way out of whack, way too high. Well, what happened at that period of time is machinery and equipment, for example, accelerated in inflation on new equipment and used equipment went up almost about 7% in a 2-year period, 7 to 8%. So did fertilizer, so did seed. A lot of things went up at the same time in concert with commodity price rises. Well, when the commodity prices came back down, a lot of the other prices stayed higher and have come down slow. And one of the primary ones is land. Back to the land for a minute, the land rents and machinery and equipment and seed and crop protection have been slower to come down. Fertilizer came down quicker because it's a commodity, so it dropped at a faster rate. And so consequently, to explain working capital and where those dollars went is the cost of production didn't come down as fast as the revenue did. So there's a vacuum taking cash out of the bottom line for the farm operations. And then that's occurred for, in a lot of operations we look at the last 6 or 7 years, we've seen a deficit of cash going out. So at the end of the year, they may have cash flowed okay, but their balance sheet is showing a negative each year, and that negative is because the cash is going out the door faster than it's coming in the door.
So they're burning through held assets.
Yes, that as well too, and that's another thing is we see one of the challenges we see for the farmers that are listening is a lot of producers have not been updating machinery and equipment. Consequently, your cost of production goes down when you have less capital invested in machinery, and maybe they're done making payments, principal and interest payments are no longer being made. So now all of a sudden, when they look at their cash flow at the end of the year, they think, well, my cost isn't as high as it was. Well, the problem is there's an inflationary component to replace that machinery is going to cost more every single year. And so if they don't take that into account as part of their cost of production, all of a sudden you're behind the game. Now, when we've seen some farm operations run on the same old machinery for 6 or 7 years because they felt like they weren't able to update anything, but at the same time thought their cost of production came down, when in reality, their cost of production is the same if they want to stay current and replace that machinery. So now they look at a piece of equipment, maybe they paid $300,000 for it 5 years ago. Now the salvage value or the trade-in value is, say, worth $150,000. So it depreciated $150,000. The problem is that $300,000 piece of equipment 5 years ago now costs $400,000. Mm-hmm. So the trade difference is $250,000, it's not just $150,000. So it's a lot more than what people are realizing. So that's a trap that I think a lot of producers are getting into as well. So that's another area where I think cash has gone away in a way that you haven't written a check for it, but it's a cost. Mm-hmm. That makes sense.
Yeah, right. Absolutely. It's interesting because, say a non-ag person might be listening to this and they're saying, man, these are some big numbers. Well, they are big numbers. And, I've always kind of said the production part of it, it gets to where we're just good at that. I mean, we've been amazingly good at it for 100 years. We've been in surplus territory for most everything we produce, truthfully. We're good at the production, and we got that pretty well dialed in. Then to stay alive, you've got to then be good at the business side of it. And, I can even reference farm people that I know. When corn was $7 a bushel, and I said something along the lines of, I don't know, man, can you justify feeding your steers $7 corn? And they said, but it isn't $7 corn. See, because I raise it myself. I said, oh. So there was this ridiculous concept of looking at money, and they somehow thought that it wasn't $7 corn because they had produced it, and it only cost them back then, say, $4 a bushel to make it. And so to them, they were feeding $4 corn. And I said, no, it is $7 corn whether you produced it or not. And they never quite grasped that. So I just see some of these things. You work with farming operations. The people you work with are pretty progressive minded. I don't suppose that they have that, but it's one of the many lack of economic awareness, I guess, I have seen among some people in our industry.
That's exactly why. So we work a lot with producers on business structure to tackle exactly what you're talking about. And we still see that, we still have had that in our operation until just some recent years, where when you look at each portion of your business should be identified as a profit center. And so what we try to do is help producers and business people look at each segment of their business and say, okay, how do we isolate that portion of your business? And so, for example, it might be their trucking, that might be an LLC, it might be its own business. Their machinery and equipment should be isolated into its own business. And then, for example, those two entities then would invoice their operating entities of whatever profit centers they have, so that way they know exactly what the cost structure is for each of those portions of the business, or it might be a livestock portion, or maybe they own car washes, or something that's even not ag related, but some external business, all needs to be in separate entities. And you're right, I see that occasionally where we'll start working with a producer and everything goes through one checkbook, and it just boggles my mind, because you have to isolate these things into their own compartment so that you can see where the costs are and be able to do the accounting accurately and more appropriately.
Talk about the farm economy. We talked about the government stuff. Okay, here we are. It's fall. Everybody gets excited about fall. It's harvest time. Whatever. What's it look like? What's the feel out there? You work with agricultural producers. What's the story?
I think there's a lot of optimism. I mean, we're eternal optimists on the farm. The biggest challenge and the most heart-wrenching thing that I've seen all year, I think, has been where the derecho went through the center part of Iowa, and we saw a lot of farm operations become just devastated in a couple of hours.
You have a video that you sent to me, and I know that people would like to see it, because Chris Barron here with AgView Solutions, he's an Iowa farmer. He's an Iowa-based agricultural business person, and he works with farming operations. So he's got a pretty good finger on this whole thing, on the pulse of this whole thing. You put a video out, and it showed the devastation of crops. I think you shot it with a drone. And then in the background of the interview, there were grain bins that looked like a giant had just come along and mashed them with his hand. Where can I see that?
So the AgView Pitch, we also have a podcast called the AgView Pitch, and then we're on YouTube, the AgView Pitch, and you view our videos there.
Yeah. So about the derecho, go ahead. The most heart-wrenching thing you saw.
Yeah, and so one of the key things that I think is very important for all of us in business, whether it's agriculture or any other business, to think about is what does our risk management plan look like? And one of the things that always scares me when I sit down and work with farm operations and some very advanced thinking operators is maybe having some gaps in their insurance coverage that they have not thought about. And that always is a concern, and something that we see pretty regularly, where people don't want to be overinsured, but conversely on the other side, you sure don't want to be underinsured. And so, for example, where the derecho went through, there are situations where a grain facility, they may have a grain facility insured for $600,000, but to replace that same grain facility that was maybe erected 10 years ago, now is maybe $1.3 million. And if they have it insured for $600,000 and they have it on their balance sheet for $600,000 and it's gone and they get that money back, but now what do? Because they can't replace that. They don't have enough insurance there to do that. And so replacement coverage insurance is something, and I don't sell insurance, so I'll say that right away here, but having replacement coverage on high capital investment items, I think, is really critical. And we see a lot of times people really underinsured. One of the other things too that we've seen is, this isn't really with structures as much, but a lot of times we see in transition too, where producers are transitioning from one generation to the next. And that's the perfect time for the exiting generation, the older generation, to buy some term life insurance on the exiting partner. I was just in a farm operation here a few days ago. That 72-year-old farmer called me, and he's looking at possibly transitioning with another farm now in his area, because he had a 48-year-old successor that was going to take over his farm that died of a heart attack this last summer. And so, you think the older person's going to be the one that's going to go, but what happens if the younger person is all of a sudden out of the equation? And so there's just, I think from a risk management standpoint, we can talk about the economy and all kinds of things, but so often there are all these what if things that you think will never happen. Yep. Whether it's, updating your will to, thinking through all of these, scenarios. And the derecho, I think, is just a really good example of something that can come out of nowhere, a black swan that can come out of the middle of nowhere that you haven't planned for. And, how can you handle that? Can you tolerate that impact?
His name's Chris Barron. His company's AgView Solutions. You can go and check out his website, and I encourage you to do so. He's a smart dude. And you know what? He's a fan of my books, too. That's the thing we really like about him. This podcast is brought to you by my good friends over at Harvest Profit. Harvest Profit, you can check them out online. Nick Horeb, the founder of the company, has a really good presence on LinkedIn in particular, and you can go there and check out his blogs. He writes blogs about the business of agriculture that are very informative. So check out harvestprofit.com, and it's a software solution that will help you run your agricultural enterprise more profitably. Okay. Last thought from Chris Barron. But before we hear from him, another thing I want to tell you about. I started a thing called the Business of Agriculture Success Group. So if you listen to this podcast and you follow my stuff, imagine going a little deeper with a small group. It's about 40 people, 30 people that are online twice a month for the Business of Ag Success Group. It's a business outlook, advisory, networking community for ag professionals. If you are interested in something you would like to be a part of, go to my website, sign up. It's only $49 for the first month. I think you'll learn a lot. Okay, Chris Barron, closing thoughts, farm, economy. What are you seeing? You already told us. Government programs, you talked about it. We only disagreed once. I think we're probably okay. I don't think it harmed our relationship. What else you got for me on the way out the door? Farm economy.
Well, what I go back to always is really, you talk about Harvest Profit. We use a tool as well. I think really knowing your numbers and sitting down and we do a podcast and we call it Dad's Wisdom. We bring in the senior operators of a farm and we talk about their wisdom. What did you learn? And one of the things that I always hear from the older producers is know your numbers, crunch your numbers, do your accounting, spend some time on the business. One way I like to put it is, as farmers, I'm very guilty of it. My wife gives me a bad time because I want to go out and mow a waterway, or I want to go out and wash a tractor or something, and I'm doing the $10, $15 an hour jobs. We have to stop and sit back and look at what we do in the next couple of years as we go forward and ask ourselves, what are we doing in our business? Are we doing the right stuff? Are we doing the $10 an hour jobs, or are we doing the $100 an hour jobs? And stay focused on that. And I think it'll all work out, because I don't think it matters who gets elected. I don't think it matters, what happens in the economy and how people get along or don't get along. We're in control of our own environment, and we can numbers, be disciplined, and work your business as much as you work in your business. And I think everything will work out just fine.
His name's Chris Barron. Check him out. AgView Solutions is his company. I appreciate you being a guest, and I appreciate your closing thoughts.
Thank you. Thanks a lot, Damian.
Do it again sometime.
Yeah, let's do that. I'm up.
All right. Till next time, it's the Business of Agriculture.